Okay, let's move on to the next one, which is double declining balance. Now we go from the very most simple method to the most complicated method. Double declining balance, if you were to have to calculate that from scratch, would require a lot of math. Okay, it's going through and evaluating what the book value was last year and applying a percentage to this year, and you have to do that all the time. But with the tables that are found on page number 219, it simplifies the double declining balance method substantially. By simply using that percentage, you can calculate the depreciation number for that year simply. Well, for instance, to give you an idea, let's take that $20,000 car. If we're going to depreciate it using double declining balance, which we can depreciate any 5- and 7-year asset using double declining balance, which includes cars. We would simply take that $20,000 original cost and multiply it times 20%. Now, if you take 20% of $20,000, what do you get? $4,000. Now, next year, we're going to have to take that $20,000 and multiply it times 32%. Okay? So next year, our depreciation is going to be 32% of $20,000. Or, anyone got that? $6,400 next year. So this year it was $4,000. We divided that by 12, and each month took 1/12, so that during the year it accumulated up to $4,000. Next year, we're going to take the $6,400 and divide it by 12, and each month depreciate $6,400. The next year, we're going to take 19.2% of $20,000, which is $3,840. We're going to take 1/12 of that each month. So every year the amount changes until you get to the last few years. Next, on the fourth year, it's 11.52%. In the fifth year, it's 11.52%. And in the final year, it's 5.76%. Why do we have a 6-year and a 5-year asset? Because this table is based on what we call the mid-year convention, which assumes that we bought it July 1st. Okay? So if we bought we only depreciate it 6 months the first year, that means we're going to have to run into a 6th year to pick up the last 6 months. And the table's permitted whether we bought it in April or November or June or whenever. You can make the assumption that you bought it July 1st. The assumption is that we bought half of our stuff in the first half of the year and half of our stuff in the second half of the year. So on average, we bought it all mid-year. Now, depreciation can be different for books than it is for tax. My recommendation is use straight line. Let the tax preparer use double declining balance. But if you ever become a tax preparer, you want to understand this. The reason or the logic behind that is if we had that same car for only 6 months, that $20,000 car for 6 months, using straight line depreciation, how much would we depreciate it in the first year? Yeah, $2,000. Okay, not $4,000 because we only had a half year, right? So we'd only depreciate it $2,000. However, double declining balance allows us to depreciate it how much? $4,000. Twice that. That's where it gets its name. It's double the straight line rate. Okay? And so it allows us to depreciate it more in that first year. Now, the more depreciation deduction you have, what happens to your taxes? We like deductions, don't we? The more deductions, the lower the taxable income and the lower tax, right? So if you're a tax preparer, you want deductions. Give me deductions, all the deductions I can get. I want them, okay? And so for book purposes, we typically use straight line. Then at the end of the year, we provide all the information to the tax preparer. Tax preparer then evaluates. See, tax preparer has a different hat on than does the accountant, okay? The tax preparer's job is to do what? Minimize taxes, that's it, okay? Take every available option possible to minimize taxes. The accountant's job the accountant's role is to provide a fair representation of the company's financial position. And sometimes they are diametrically opposed on there. So that's the reason for book purposes we use straight line. It more fairly shows what's happening to the value of the assets. And it's also easier. We like that too. For tax purposes, at the end of the year, the tax preparer is the one that's going to be most often the user of double declining balance. If we have a desk that cost us $1,400, how much are we going to depreciate it in the third year? Desk, $1,400. $17.49%. So calculate 1,400 times 17.49%. What'd you get? $244.86. Okay, would be its depreciation that year, right? Okay. Questions on that?
What was the cost of the desk?
$1,400 was the original cost. So $1,400 times 17.49%. 244.86. Is that right? Is that what you said? Okay. Then you divide that by 12, and each month do 1/12. Now that is if you were doing it for accounting purposes. But once again, we've identified that most often for accounting purposes, which method are we going to use? Straight line for accounting purposes. So accounting, it's real easy, right? You just take the original cost and you divide it by the number of years, and then you divide it by 12 for monthly depreciation. So it just makes it easier. We don't worry about this. This is used for what? Double declining balance is used for tax purposes. So the tax, and when are taxes prepared every month? No, they're prepared at the end of the year. So it's a very easy calculation, just multiplying this percentage times the original cost.